Every Monday morning at 6:45 a.m., millions of professionals engage in a ritual of collective self-deception. As you sit in bumper-to-bumper traffic, coffee in hand, listening to a podcast to numb the monotony, you convince yourself that this 35-minute drive is merely a neutral transition. In financial terms, we call this the commute fallacy. You have been conditioned to believe that your workday begins when you badge into the office and ends when you log off. But as a senior analyst, I must challenge that premise. You are not commuting to work, you are performing unpaid labor. The market operates on a concept called bounded rationality. We make decisions based on the information we are given, usually the gross salary figure, while ignoring the systemic costs required to earn that salary. Your employer has sold you on the dream of a 40-hour work week, but they have conveniently offloaded the logistics of human delivery onto your shoulders. They demand your presence, your stress, and your punctuality, yet they compensate you exactly $0 for the time spent in transit. This is a classic case of information asymmetry. From the moment you strap into your vehicle, your autonomy is gone. You are no longer in personal time, you are in pre-work limbo. You are navigating hazards, managing cortisol spikes from aggressive drivers, and mentally preparing for the day's agenda. If you were required to sit in a meeting for 70 minutes a day without pay, you would call it wage theft. Yet, when those 70 minutes are disguised as a commute, you accept it as a part of the job. By failing to account for this time, you are effectively giving your employer a massive, unearned discount on your talent. You think you're selling 40 hours of your life, but the reality is closer to 50 or 55. In the next section, we will strip away the polite language of salary and use the inversion model to calculate your real hourly wage. The results are not just sobering. They are a direct indictment of the modern employment contract. To understand the true state of your finances, we must apply the mental model of inversion. Instead of looking at what you are given your gross salary, we must look at what you actually keep after the structural costs of employment are subtracted. Most people anchor their self-worth to a number on a contract. If the contract says $65,000, they believe they earn $31.25 an hour. But as any forensic accountant will tell you, the top-line number is a vanity metric. The only number that matters is your real hourly wage. Let's perform a financial autopsy on Maya, a mid-level accountant earning that $65,000. On paper, she is a success. But when we apply full cost accounting, the facade crumbles. First, we must account for the taxation leakage. After federal, state, and FICA taxes, Maya's take-home pay isn't $65,000, it's $48,000. This is her actual fuel for life. Now, we must analyze the time leakage. Maya believes she works 40 hours a week. However, her job consumes much more than the time spent at her desk. We start with grooming labor. Maya spends 30 minutes every morning on professional presentation, hair, makeup, and attire that she would not wear if she were not being observed by her employer. Next, we factor in the commute limbo, 30 minutes in the morning and 45 minutes in the evening traffic. Finally, we add decompression time. After arriving home at 5:45 p.m., Maya requires at least 30 minutes to transition out of work mode, venting about the day or answering residual emails. When you add these invisible hours, Maya's job doesn't consume 8 hours a day. It consumes 12 hours and 15 minutes. Over a 50-week work year, Maya isn't working 2,000 hours. She is sacrificing 3,062 hours. Now, let's do the brutal math. $48,000 divided by 3,062 hours drops her hourly rate from $31.25 to $15.67. But we aren't finished. We haven't even touched the literal cash outflow required to move her body to the office. Maya drives a fuel-efficient sedan, but the IRS standard mileage rate, which accounts for gas, insurance, maintenance, and the silent thief of depreciation, is 67 cents per mile. For her 2.5-mile daily round trip, Maya is paying a commute tax of $4,187 per year. When we subtract that $4,187 from her $48,000 take-home pay, we are left with $43,813. Divide that by her 3,062 hours of job-related sacrifice, and we arrive at the terrifying reality. Maya's real hourly wage is $14.30. Maya is an educated professional with an accounting degree. Yet after the commute scam, she is earning roughly the same as a fast food worker who lives within walking distance of their job. The $65,000 salary is a mirage. The commute didn't just cost her a raise, it cut her economic value in half. She is running a marathon while carrying a 50-pound backpack of hidden costs, wondering why she feels so exhausted yet remains so far from the finish line of financial freedom. If you don't calculate your real hourly wage, you are making career decisions in the dark. You are selling your life at a discount, and your employer is the only one profiting from your lack of math. In the world of value investing, we look for assets that produce cash flow. A car, however, is a negative asset. It is a complex machine whose sole economic purpose in the context of a commute law to facilitate your labor at the highest possible cost to you. Most commuters suffer from linear accounting bias. They look at the $40 they put in the gas tank and think that is the cost of driving. But from a senior analyst perspective, gas is merely the tip of the iceberg. The real predator is the silent, relentless force of depreciation. Every mile you drive on that highway is a physical withdrawal from your vehicle's terminal value. According to the IRS standard rate of 67 cents per mile, we are factoring in the full lifecycle cost. This includes the sunk costs of insurance and registration, the maintenance liabilities of tires and oil, and most importantly, the loss of the vehicle's resale value. When Maya drives 6,250 miles a year just for her job, she is effectively liquidation selling her car to her employer, 1 mile at a time, for $0. Let's analyze the mechanical entropy of the commute. Highway driving in stop-and-go traffic is the most inefficient use of an internal combustion engine. You are burning fuel to move 0 inches. You are wearing down brake pads to stop a momentum you just paid to create. This is entropy in its purest financial form, energy and capital being wasted to maintain a status quo. Furthermore, we must address the risk premium. Every minute spent on the highway increases your statistical probability of a black swan event, a collision. Even a minor accident can result in a diminished value claim, instantly wiping out thousands of dollars in equity. Your employer does not share this risk. If you total your car on the way to a meeting, your employer's balance sheet remains untouched, while your net worth takes a catastrophic hit. You are providing the logistics infrastructure for their company for free, while absorbing 100% of the liability. In the logic of capital allocation, Maya is making a terrible trade. She is using a high-cost, rapidly depreciating asset to earn a wage that is being systematically eroded by the very act of using that asset. It is a death spiral of capital. If you view your car as freedom, the math suggests otherwise. In the context of a commute, your car is a mobile capital sinkhole that ensures a significant portion of your salary never actually reaches your savings account. It evaporates on the asphalt long before you ever reach the office. In the discipline of wealth management, we rarely focus on the money you spend. We focus on the wealth that never was. This is the mental model of opportunity cost, the loss of potential gain from other alternatives when one alternative is chosen. When you spend $4,187 a year on a commute, you aren't just losing $350 a month. You are forfeiting the most powerful force in the financial universe, compounding interest. To understand the magnitude of this theft, we must look at the terminal value of capital. Let's return to Maya. She's 25 years old. If she were to take that commute tax of $4,187 and instead of feeding it into her gas tank and insurance premiums, she funneled it into a low-cost S&P 500 index fund, the math changes from a tragedy to a miracle. With an average annual return of 8%, that gas money would swell to over $112,000 in just 15 years. By the end of a 40-year career, that single decision to eliminate the commute would result in a portfolio worth approximately $1.1 million. This is the million-dollar gap. When you accept a long commute, you aren't just accepting a longer day. You are effectively signing away your millionaire status at retirement. You are choosing to enrich the oil companies and auto manufacturers today rather than enriching your future self tomorrow. This is the asymmetry of gratification. The convenience of living in a cheaper suburb further away is an illusion, because the suburban discount on rent is being systematically cannibalized by the commute tax on your future wealth. Furthermore, we must account for time as an asset class. Maya spends 625 hours a year in her car. Over 40 years, that is 25,000 hours. To put that into perspective, it takes roughly 10,000 hours to master a complex skill. In the time Maya spends staring at brake lights, she could have mastered 2 separate professions, learned 3 languages, or built a high-valuation side business. By sitting in traffic, you are suffering from human capital depreciation. While you are stuck in the left lane, your skills are stagnating, your energy is depleting, and your wealth engine is idling at 0. The highway is a cemetery for ambition. Every mile of pavement is a mile further away from the life you could have built with that time and that capital. In the logic of value investing, the commute is the ultimate value trap. It looks like a necessary part of a good job, but it is actually a slow-motion heist of your entire financial legacy. In the world of investing, we often discuss the risk premium, but we rarely quantify the biological tax of our career choices. Your body does not distinguish between a threat from a predator and the frustration of a traffic jam. It responds to both with a surge of cortisol and adrenaline. When you subject yourself to a daily commute, You are placing your physiology in a state of chronic, low-level fight or flight. This isn't just an inconvenience. It is a systemic withdrawal from your most valuable asset, your health. From a behavioral economics perspective, your health is a productive asset. A body in a state of chronic stress is a body that is rapidly depreciating. Studies from the University of Montreal and various health institutes have confirmed the correlation between commutes longer than 20 minutes and elevated blood pressure, increased BMI, and lower overall life satisfaction. You are paying for your job with your cardiovascular health. Let's analyze the second-order effects of this biological tax. A morning spent navigating a high-stress highway means you arrive at the office already cognitively depleted. You have burned through your morning supply of executive function before you've even sent your first email. This leads to lower productivity, poor decision-making, and a reduced capacity for the kind of high-level creative work that actually leads to promotions and raises. You are effectively giving your employer an exhausted version of yourself, while you personally absorb the medical liabilities. Furthermore, consider the hidden medical costs. Chronic back pain from prolonged sitting, weight gain from a sedentary lifestyle, and the inevitable cost of sleep aids or therapy to manage work-related anxiety. These are not just life expenses, they are direct costs of the commute. You are making yourself sick for free and then using your hard-earned salary to buy back the health you lost while earning it. In the logic of wealth building, this is a net negative loop. Your employer gets the hours, the healthcare system gets the fees, and you get the burnout. If you wouldn't accept a job that required you to take a slow-acting poison every day, why would you accept a commute that does the exact same thing to your heart and mind? In the final audit of your life, the time and health lost on the highway are the only debts you can never repay. In the world of professional trading, arbitrage is the act of exploiting a price difference between two markets. To reclaim your salary, you must apply this same logic to where you live and how you work. Most people are stuck in a spatial mismatch. They live in the suburbs to save $500 on rent, only to spend $800 a month in commute tax and time. This is not a saving. It is a negative arbitrage. Let's look at the first strategy. Remote leverage. When Maya transitioned to a fully remote role, she didn't just gain a $4,000 salary bump, she performed a structural reorganization of her life. By eliminating the commute, she effectively gave herself a 25% real-term raise. She reclaimed 520 hours per year, which she then arbitraged by starting a side business. This is the multiplier effect. Remote work doesn't just save you money. It grants you the inventory of time necessary to build secondary income streams. In 2026, a desk job that requires a 5-day physical presence is often an obsolete management model that is costing you tens of thousands of dollars in lost velocity. The second strategy is the urban density paradox. Many believe they can't afford to live near the office because the rent is higher. However, when we apply total cost of ownership logic, the math flips. If Maya moves downtown for an additional $500 in rent, but eliminates her car entirely, she isn't just saving on gas. She is eliminating car payments, insurance, registration, and the psychological burden of maintenance. By selling her car, Maya converts a depreciating liability into liquid capital. If she uses that liquidity to pay down debt or invest, she has successfully performed a balance sheet optimization. She has traded a metal box on the highway for a walkable lifestyle. From a logic-based perspective, paying higher rent to be near work is often the cheapest investment you can make in your human capital. It reduces your biological tax, increases your sleep, and provides you with the most valuable commodity in the world, zero friction. In the modern economy, distance is a tax that you pay with your life. The great arbitrage is about refusing to pay that tax. Whether you move your desk to your home or move your home to your desk, the goal is the same: to stop the hemorrhage of your most finite resources. We conclude this financial forensic audit with a question of sovereignty. In the world of wealth building, we often obsess over net worth, but the true metric of a successful life is net time. Time is the only asset that is perfectly finite and non-renewable. When you eliminate a 60-minute daily commute, you aren't just saving a few dollars, you are performing a life expansion. Let us look at the final, staggering math of Maya's reclamation. 10 hours a week regained equals 520 hours per year. In the context of a standard 8-hour workday, that is 65 days of life returned to her. Every single year, Maya now has an additional 2 months of waking life that were previously being liquidated on the highway. This is the time dividend. Imagine what you could achieve with a 2-month bonus every year. You could learn a new language, master a technical skill that doubles your market value, or finally build the physical health you've been sacrificing to the biological tax. More importantly, you gain the sovereign power to be present. You are no longer the exhausted, cortisol-depleted version of yourself that walks through the door at 6 p.m. You are a person with the energy to cultivate relationships, hobbies, and a legacy. The most insidious part of the commute scam is that it makes you feel like a passenger in your own life. It normalizes the idea that your time is not yours until someone else stops paying for it. But as a value investor in the business of living, you must realize that the market does not price your life correctly, only you can. If you find yourself in the commute limbo, you must make a strategic choice. Do not accept busy as a badge of honor. Busy is often just another word for inefficient capital allocation. Use the data we've uncovered today as your leverage. Calculate your real hourly wage, confront the million-dollar theft of your loss compounding, and then execute a plan to exit the highway. Whether you negotiate for remote work, move closer to the urban core, or find a role that respects your time, do not wait. Every mile you drive is a mile of your life you are giving away for free. Reclaim your hours, reclaim your health, reclaim your sovereignty. The highway is a choice, it's time to choose a different path.